Something happened this Friday that most silver holders are going to wake up Monday morning completely unprepared for, and the window to act is closing faster than the Asian markets open Sunday night. Silver closed today, Friday, June 26, 2026, at $58.19 per troy ounce. That sentence sounds calm. It is not calm. That number is the surface of something far more consequential than a single Friday close, and what sits beneath it, in the structure of this market, in the behavior of the physical metal, in the arithmetic of where we came from, is exactly what the noise of a correction is designed to prevent you from seeing clearly. Most people watching this price right now are watching it wrong. They are watching it emotionally. An emotional observation of a complex market is not analysis. It is theater. Let us establish the facts with the precision they deserve. Silver's all-time high was 121.78 per troy ounce, struck on January 29, 2026. Today's close represents a decline of more than 50% from that peak. That is a number that triggers panic in the nervous system before the rational mind has a chance to intervene. 50%. The brain hears that and reaches immediately for the exits. But here is what the brain, acting on instinct rather than history, consistently fails to consider. In 2010 and 2011, silver ran from roughly $18 to $49. It then corrected to $26. That was a 47% drawdown from peak. The investors who measured their position against the $49 top locked in losses at $26. The investors who measured their position against their actual entry, near $18, recognized that $26 still represented a 44% gain, and they stayed positioned for the cycle that followed. History does not repeat, but in commodity markets, it tends to produce rhymes so precise they deserve serious attention. Wait, before you do anything else this weekend, you need to understand the one number that almost nobody is talking about. Because this correction is not what it appears to be on the surface, and if you miss this distinction, you will make the single most common mistake in a precious metals bull market. The gold-silver ratio closed today at 69.56. That is the number of ounces of silver it takes to purchase 1 ounce of gold. In late January 2026, when silver was approaching its peak, that ratio compressed to as low as 50, a 14-year low. It has since expanded back to nearly 70, which is the market's way of telling you that silver has been punished harder and faster in this correction than gold has been. Gold corrected roughly 29% from its record high of $5,594. Silver corrected more than 50%. That divergence is not random, it is structural, and understanding it is the difference between reacting to a correction and reasoning through one. Here is what is actually happening. Silver trades as two things simultaneously. It trades as a monetary metal, which means it responds to interest rate expectations, dollar strength, and the same safe haven calculus that moves gold. But it also trades as an industrial metal, which means it is sensitive to global manufacturing activity, technology demand, and the physical supply chains that feed solar panels, electric vehicles, and increasingly the infrastructure of artificial intelligence. When a hawkish Federal Reserve pivot hammers the paper futures market, which is exactly what has happened as the CME FedWatch tool now shows traders pricing in a 64% probability of another rate hike in September, silver gets hit from both sides. The monetary side sells because rising real rates make non-yielding assets less attractive. The speculative industrial side sells because higher rates mean slower growth and potentially softer commodity demand. The paper price falls, and the investors who cannot distinguish between a paper-driven correction and a structural breakdown in the underlying thesis do exactly what the market is designed to cause them to do. They sell. Now here's the fact that will reframe everything you think you know about where silver is right now. This market has been in a structural supply deficit for 6 consecutive years. Not 5, not 4, 6. Global mine supply cannot respond quickly to price signals because 72% of silver production comes as a byproduct of base metals mining, copper, zinc, lead. When silver prices fall, the mines producing those base metals do not stop production. The silver comes out regardless. But the deficits persist because the demand side of this equation is locked into multi-year capital expenditure cycles that do not pause because a paper futures market is nervous about a Federal Reserve meeting. The solar industry alone has consumed hundreds of millions of ounces annually. Electric vehicle production has built silver into its supply chains as a structural input. These are not discretionary purchases. They are engineering specifications written into production contracts years in advance. Stop scrolling right now, because what I am about to tell you about January 2026 is the single most important event in this entire correction, and most people have already forgotten it happened. In January 2026, in the span of 7 days, 33.45 million ounces of silver were physically withdrawn from COMEX registered inventory. That was approximately 26% of all deliverable physical silver disappearing from the vault system in a single week. Silver lease rates, the annualized cost to borrow physical metal for delivery, spiked to 8%, the highest ever recorded. Traders who held paper claims to silver discovered, under delivery pressure, that the system was not built to handle simultaneous demand for actual physical metal. The price discovery mechanism began to fracture. The paper price and the physical price began moving in different directions. Today, at a paper price of $58 to $59, physical silver at major U.S. dealers is trading at premiums of $2.50 to $5 above spot. That is the physical market telling you something the futures market is not telling you. The people who need actual silver, the people who need to take delivery of a specific bar in a specific vault, are paying meaningfully more than the number you see quoted on any financial website. That gap is not an anomaly, it is a signal. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk. You have been watching the wrong number all week. Everyone has been watching the price of silver. Almost nobody has been watching the 3 metrics that actually predict what happens when markets reopen. There is a particular kind of clarity that arrives when you remove noise and look at structure. The price of silver at any given moment on any given Friday afternoon is, in the strictest analytical sense, the least predictive number available to a serious long-term investor. That price is being set in real time by paper futures contracts in a market where algorithmic trading models, rate-sensitive institutional portfolios, and speculative positions built on Fed expectations are all responding simultaneously to the same headlines. It is a snapshot of sentiment about monetary policy, not a statement about the structural balance of supply and demand in the physical market. Those are 2 entirely different things, and conflating them is the foundational error from which every other bad decision in a correction flows. The first number that actually matters right now is the COMEX registered inventory coverage ratio. This is the percentage of total COMEX silver open interest that is backed by actual deliverable physical silver sitting in registered vaults. The CME Group publishes this data every trading day at approximately 4 in the afternoon Eastern Time. When that coverage ratio falls toward 10% or below, the paper leverage in the system is rising, and the system is becoming vulnerable to exactly the kind of delivery stress we saw in January, when 26% of registered inventory was withdrawn in 7 days. The most recent data shows this ratio hovering in the low teens. If on Monday it ticks down toward 11 or 10%, that is your earliest possible signal that physical tightness is building underneath a paper sell-off. That is the exact structural setup that preceded the January spike. The second number is silver lease rates. Right now, lease rates are sub 2%, which means there is no immediate stress in the physical borrowing market. That is actually good news for the medium-term thesis. It means the January delivery crisis has not yet repeated. But lease rates are also a leading indicator, not a concurrent one. In January, rates moved from below 2% toward 8% in a compressed time frame. If you see lease rates beginning to move from 2% toward 3 and then 4%, that is the canary in the coal mine. Someone somewhere needs physical silver and is willing to pay to borrow it. That demand does not show up in the futures price until it is severe enough that it cannot be hidden. It shows up in lease rates first. If you've been sitting on the fence about whether to subscribe, let me tell you this plainly. The people who get the next alert, when this market shifts on a Monday morning without warning, will be the ones who made the decision today. Hit subscribe right now, turn on the notification bell, and stay in front of this. The third number is the gold-silver ratio at 69.56, which I have already described in some detail. But let me give you the specific mechanical implication. Every 1-point compression in that ratio from current levels represents silver outperforming gold by approximately 1.4%. If the ratio moves from 69 back to 60, a move back to roughly where it was just weeks ago, that is a 13% outperformance by silver relative to gold. Not a 13% absolute price gain, a 13% outperformance relative to gold, which means if gold is flat, silver gains 13%. If gold recovers modestly, silver gains more. That ratio compression is the mechanism through which silver reasserts its leadership role in a precious metals bull market, and historically it happens fastest when the paper-driven selling pressure exhausts itself and physical demand re-anchors price discovery. Now let us talk about the Federal Reserve, because the current narrative around monetary policy is critically important to understand accurately, and it is being widely misread. The article circulating today says markets are pricing in 3 rate hikes this year. Deutsche Bank and Goldman Sachs have both cut their gold price forecasts. The dominant interpretation is that the Fed is committed to a hawkish path, and that this path is a sustained, structural headwind for precious metals. That interpretation is based on inflation data from a period that is already over. Here is the fact that changes the entire picture. West Texas Intermediate crude oil is down from $113 per barrel in April to approximately $76 today. That is a 32% decline in the primary input cost for the entire inflationary architecture of the economy. Energy prices feed into transportation, manufacturing, food production, chemicals, and dozens of other cost structures. When oil falls 32%, the inflationary pressure that justified rate hike expectations begins to dissipate. But it does so on a lag of 60 to 90 days. The inflation prints the Fed will see in July and August will reflect energy prices from May, June, and July, a period in which oil has been in the 70s and low 80s. The inflation data driving the current 3-hike narrative reflects oil at $100 and above. The Fed is not locked into a path. The Fed is data dependent, and the data is changing. Markets reprice when new information arrives. The current monetary headwind pressuring silver is built on assumptions about inflation that the energy market is already dismantling in real time. This does not mean the Fed pivots next week. It means the market is currently pricing 3 rate hikes based on inflation data from a world in which oil was 32% more expensive than it is today. What very few people are discussing right now is the geopolitical architecture underneath the gold and silver bid. The US-Iran situation that began in March has created a persistent, structural bid for monetary metals that exists entirely independently of Fed policy. Central banks globally purchased 244 metric tons of gold in the first quarter of 2026 alone, the second highest quarterly figure on record, up 42% year over year. These are sovereign institutions operating on multi-decade reserve strategies. They do not respond to Fed meeting minutes. They respond to the structural forces driving dollar reserve diversification, geopolitical fragmentation, and the reality that fiscal deficits in the United States remain on a trajectory that no credible analyst expects to reverse in the near term. That institutional bid is structural, not speculative, and it sits underneath the paper-driven selling that is currently setting the price. There is also a technical level that genuinely matters, and it is the only technical level worth discussing in the context of the current correction. Silver spent 13 years, from 2013 to 2025, repeatedly failing to establish itself sustainably above $50 per ounce. In late 2025, it finally broke above that level and held it for months, running to $121 by January. That breakout above $50 was the technical market's confirmation that the structural supply deficit and industrial demand growth had finally aligned to push silver into a new trading range. $50 is the floor of that new range. A sustained weekly close below 50, which would require approximately a 13% additional decline from Friday's close of $58.19, would constitute a technical failure of the breakout. That is the level that changes the picture. Everything above 50 is volatility within a structurally intact bull market. A sustained break below 50 is a structural question that requires honest reassessment. Silver is currently at $58. It tested as low as $57 this week. It is $7 to $8 above the level that would actually matter. That is not a license for complacency. It is a framework for clarity. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk. This next part is the one nobody wants to hear, but it is the most important thing I will say in this entire video, and if you are holding silver right now, you need to sit with what I am about to tell you. There is a conversation that almost never happens in precious metals communities, and its absence is directly responsible for the difference between the investors who survive corrections and the investors who get destroyed by them. That conversation is not about the thesis. It is not about supply deficits or industrial demand or the Federal Reserve. It is about the relationship between the size of your position and the length of your time horizon, and the honesty required to assess whether those two things actually match. Ole Hansen of Saxo Bank noted in today's analysis that investors are heading for the exit or reducing exposure. ETF outflows are continuing. Speculative positioning has already been significantly reduced. That selling pressure is not coming from people who have changed their view of silver's long-term structural case. It is coming from people who are positioned too large relative to their liquidity and their time horizon. They are being forced out. Not because the thesis is wrong, because the position size was wrong. If you purchase silver in late 2025 or in January 2026 near the peak, your cost basis is somewhere between $90 and $121 per ounce. At $58.19 today, you are carrying a real unrealized loss of between 35 and 52%. The question that determines your next action is not whether silver will recover. The structural case for recovery, the 6-year supply deficit, the industrial demand locked into multi-year capital expenditure cycles, the physical market trading at premiums above the paper price, the gold-silver ratio at levels that have historically preceded silver outperformance, is well documented and broadly intact. The question is whether you can hold this position for 18 to 24 months without being forced to sell for any reason unrelated to the thesis. If the answer is yes, if you have the liquidity, the emotional capacity, and the genuine time horizon to wait for a recovery that could extend to late 2027 or 2028 based on how previous silver cycles have resolved, then the correct action this weekend is to do nothing except verify that the structural conditions are still in place. Update your thesis, check your metrics, mark your technical levels, and wait. But if the answer is no, if you are facing margin pressure, if you need liquidity in the next 6 to 12 months, if you are checking the price every hour and losing sleep, then you need to reduce your position to a size you can actually hold without being forced to make a decision based on something other than the thesis. A smaller position held through a recovery is worth more, in every way that matters, than a larger position sold at the bottom because you ran out of time or liquidity. This is the action that separates investors who survive corrections from investors who become the forced selling that creates the recovery for everyone else. There is one more dimension of this that almost no one is addressing publicly, and I want to address it with the specificity it deserves. Not all silver holdings are structurally equivalent. If you own physical silver in your own custody, coins or bars in a vault you control, you own metal. There is no counterparty. No one can call a margin on it. No one can restrict your access to it. No one's solvency stands between you and your asset. If you own PSLV, the Sprott Physical Silver Trust, you have an allocated counterparty with legal redemption rights, a specific audited vault where specific bars are held in your name, with a documented legal right to demand physical delivery if you meet the unit minimum. If you own SLV or another cash settlement ETF, you hold a paper claim on a trust. Your return tracks silver's price, but you have no personal right to demand delivery of a specific bar. You have no counterparty protection equivalent to PSLV's allocation structure. In January 2026, when 26% of COMEX registered inventory was withdrawn in 7 days and lease rates hit 8%, that distinction mattered. If the physical market experiences another delivery stress event of that magnitude, and there is no structural reason to believe it cannot, that distinction will matter again. There is something happening in this market right now that most retail investors simply never see until it is too late. The paper market and the physical market are beginning to diverge again. Physical silver premiums of $2.50 to $5 above spot tell you that the people who need actual metal are paying more for it than the price you see quoted on any financial terminal. That divergence was present in January before the delivery crisis. Watching it now is not paranoia. It is attention to structure. Here is the 72-hour framework before Asian markets open Sunday night and the full week of trading begins Monday. Write down your actual entry price, not the January peak, not the price you wish you had paid, your actual cost basis. Calculate your actual return at 58.19 and measure from there. Verify exactly what you own and what its counterparty structure is. Check the COMEX registered inventory ratio on Monday's CME report. Watch silver lease rates for any movement above 2%. Monitor the gold-silver ratio at 69.56 for signs of compression below 65 or expansion above 72. Assess honestly whether your position size matches your time horizon and reduce if it does not. And then make the commitment that matters most, a commitment about what you will not do. You will not check the price every 45 minutes. You will not make a decision based on a single session's move. You will not sell based on fear or hold based on hope. You will operate from conditions you have defined in advance, from metrics you have decided to watch, from levels you have already marked on your chart. The investors who survive market corrections and come out positioned on the other side are not the ones who predict the bottom. They have never been the ones who predict the bottom. They are the ones who have a plan before the bottom happens and the discipline to execute it when the conditions they defined in advance actually arrive. And right now, I want to ask you something directly. Where did you buy silver? What was your entry? Are you above your cost basis or below it? Drop your answer in the comments right now, not because it changes the thesis, but because this community is watching this market from every time zone on Earth, from New York to London to Singapore to Sydney, and the people reading those comments are doing the same analysis you are doing, from the same data, with the same questions, and sometimes knowing you are not alone in this is itself a form of discipline. Tell me where you stand. Tell me what you own. Tell me what your plan is, and let's figure this out together. Because the next phase of this market does not wait for anyone who is still deciding. The thesis is intact, the correction is real, the structure is still in place, and the 72 hours in front of you are the window that matters. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think